Hey guys, welcome back to another one of my videos. My name is Kong Meng Lee. I'm a realtor with Partners Realty and a licensed life insurance agent. Today, I wanted to talk to you guys about why I think the IUL is a great life insurance policy for kids. Again, this is not legal or financial advice. This is just me going over my thoughts or experiences for entertainment purposes only. Now, with that said, let's begin. For those of you who don't know what an IUL is, it's a Index Universal Life Insurance Policy. An IUL is an annual renewable term life insurance policy that takes part of your premium and invests it into the index, such as the SP 500. Like many life insurance policy, you have a fixed premium, so you pay the same amount every single month. So for example, if I quote you $50 a month for your premium, you'll be paying $50 a month until the insurer has passed away. But unlike most insurance premiums, this premium is actually flexible. That means if you don't have enough money to pay your $50 a month, you could pay $40 a month. And vice versa. If you have more money and you want to put more into your policy, then you could put $60 a month into your policy. So, of course, the amount of money that you put towards your premium will affect how your policy performs in the index. Now, because your term policy automatically renews every year your rate of insurance will go up. The idea is that when you start with a higher premium than your regular term life insurance, the rest will be put into the index and then invested and grow at a higher rate than your term life insurance policy would. Over the year, the growth in cash value will just be added to your death benefit. So your death benefit will grow as well. Let's take a look at a simple illustration. Say you have a 1-year-old baby girl and you want to buy a $50,000 index universal life insurance policy. Here is what the illustration will look like. So you can see that your premium is going to start at $15.17 per month. Your death benefit option is going to be option B, which means it will increase. That means it will accumulate and get added to your death benefit. And your face amount is $50,000. Again, 1517 is a monthly premium that is recommended for you to pay to get benefits from your policy. Now we scroll down to page 10, you can see that we have three different columns: a guaranteed, non-guaranteed, and another non-guaranteed at different interest rates. So here at the guaranteed column, which means that no matter how bad the index perform, we will guarantee you a rate of 0.25%. Even when the rate is negative 30%, our floor is the lowest amount, which is 0.25%. And here on this page, you can see that, yes, with every floor, we do have a ceiling. So with the SP 500, we are looking at a cap of 11.5%. The gold has a cap of 16%. The Dow Jones has a spread of 3.25%. And Barclay is actually a 0% spread and 200% cap. So that means that you are actually getting 200% of whatever the Barclay comes out at. Going back to the illustration, this middle column shows 4.5% interest rate. This is basically 68% of the average of the last 20 years. So if we go back to this table, the last 20 years, it will show you how it performed and what are the averages. This last column shows an interest rate of 6.36%. This is what we will actually use for our illustration. It just gives the percentage of the average last 20 years of performance for that index. Again, interest rate goes up and down throughout the years and will never stay fixed like our illustrations. If you want a better illustration, refer to my previous video where I ran the numbers based on the actual yearly performance of the SP 500. Now, taking a look at this illustration, we can see that this is guaranteed for 15 years. That means that if the market continuously crashes for 15 years straight, this policy will lapse. Keep in mind that if the market does have a negative return for 15 years straight, we will be in an economic crisis. Even 5 years straight will cause major depression or financial crisis. If it performs at a 68% of the past average, then it will last all the way down to 82 years. And if it continues at the same rate of the average, it will last all the way down to 119 years. If your policy ever does get to the point where it may lapse, you will be notified and you can choose to either let it lapse or increase your monthly premium. Now, something to look at is that your account value is highest at the year of 88. So if your insured passed away here, you will get more than just the $50,000. You're going to get this account value added on top of the $50,000, which is $116,000. Although you may be paying more than a term life insurance policy, you're paying less than a whole life insurance policy and getting a lot more benefit. So, why would I say that the IUL is a great life insurance policy for kids? I firmly believe that the IUL is most beneficial to have when you are young and you overfund the policy. This is beneficial for younger people because it gives the cash value more time to grow. It's not just a linear growth, it actually grows exponentially. And I'll show you an example here in a bit. But remember when I said the premium is flexible? The more you put into your premium, the more you invest into the index. And that's what I mean about overfunding the policy. So let's say your target premium is 30 bucks a month. You put in 50 bucks a month. All the extra money will be put towards the index. Since the monthly fee for the term policy don't change until the following year, your money will grow faster. There is, however, a maximum amount you can put towards your policy so that it remains tax-free. If we take a look at this page, it'll show us that our annual maximum contribution to this policy is $1,024. If you put more than that, it becomes a modified endowed contract, also known as a MEC. This is then an investment vehicle, and then you will be taxed accordingly. So let's take a look at an illustration where we actually max out the policy premium. So again, you're going to have gender a female, age 1, non-tobacco, face amount is $50,000. Now your premium is going to be $85.37, and that's just the 1024 from the previous example divided by 12. It gives you $85.37 a month. Now, as you can see with this one, we are guaranteed a lot longer. The policy is guaranteed not to lapse until year 91. And let's take a look at the growth of the account value. This gives your child so many benefits. So for an example, if you look at the age of 18, your account value is already at $26,000. This means that you can technically get a loan from your policy and buy your child a car at $26,000. Or at 21 with $31,000. You can technically use that for the student loans. If we look here at the age of 30, we have $66,000. You can take a loan against that and put it towards a house payment. And lastly, at the age of 71, if the insured has passed away, they're leaving behind $1 million. Now remember, the cash value is what you can take a loan against. These loans are not taxable against your income. Also, if you don't pay it back at the end, they will just take it away from the death benefit. Another great thing is that it is a loan against your account value, so they never take the actual account value away. This account value will continue to grow as the year go on. And beyond that, we have a lot of other benefits such as living benefits. So it covers any critical, chronic, or terminal illnesses. And these are the amount that you can get. These amounts can be taken out while the insured is still alive to help them with either their healing processes or just living benefits. Lastly, you might say, why should I keep paying these premium even when the policy has grown so much? Well, that's the benefit of a flexible premium. You don't have to. Let's say you max out the policy only until your kids are old enough to take over, say at like age 21. If they want to take it over and continue paying, that's up to them. But you can just stop the payment and let's see how long it takes for the policy to lapse. So here's the illustration. Again, you're still paying that $85.37 a month. But let's say you wait until they're 21 and you stop the payment completely. So there's no more payments coming from you. Now, if we scroll down, we can see that the policy will be guaranteed until age 69, even though you're not paying any more premium. And because you've paid so much premium in the beginning. You've allowed the account value to accumulate so much cash that it continues to grow even though you're not paying any more premiums. That is because, again, this compounds exponentially and not linearly. You can even make it where you retire off the policy and it pays you an income, but we'll save that strategy for later. So if this is something that you or your family is interested in, please let me know. I'll be happy to run an illustration for you. Again, the IUL is a pretty powerful vehicle to invest in at an early age. It gives you more time to allow the policy to grow in account value, and the more you fund the policy, the more you will have at the end. This is why I think the IUL is a great policy for kids. And that wraps up my video on why I think the IUL is a great life insurance policy for kids. I hope you've learned a lot, and if you have any questions or comment, please feel free to leave them down below. I'll see you on the next video.